Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Lara Castleton. She's the U.S. head of portfolio construction and strategy at Janus Henderson Investors to discuss alternatives to money market funds and the debate around the 60-40 portfolio. Lara, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me, Jill.
You got it. Given the recent run-up in yields, how has the use of money market funds by clients evolved?
Money markets and assets have nearly doubled in the last 5 years. They've gone from about 3 to almost 6 trillion in assets. And if you think about where we've been over the last 5 years, it's not surprising why that is the case. We had COVID, recovery. We have for over 18 months had still the most anticipated recession of all time. And so amid uncertainty, however much we would love to keep our clients invested in the markets during those times, they do tend to fly to money markets for safety. So that growth in money markets is probably understandable. Even just this year, we've seen almost 800 billion in inflows to money markets. Now is a game changer because you're finally getting paid on those money markets. So where you weren't really getting much compensation for it, the fact that you get over 5% has completely changed the game in terms of money market funds this year.
Is Janus Henderson recommending that clients consider alternatives to money market funds as the peak of the Federal Reserve's rate hike cycle nears?
Yeah, so that's one of those things that is so much easier said than done, but the answer is yes. Historically, when the Fed pauses, that is typically the time when you don't want to be in cash. That's just simply because the next step after this is maybe potentially lower in terms of interest rates. And so congratulations to being in money markets during this year. However, going forward, there's a lot of other opportunities that you can go to. And with clients that I work with, so I consult with clients daily in their fixed income portfolios, they are talking to their clients about money markets. One of the conversations we've had that has been resonating is, let's not just jump from your money market allocation full on into TLT or 20-year treasury, because that's going to introduce a whole different type of volatility. But for clients that are really hanging on to their money markets, let's edge them out a little bit. Let's at least start by going into the ultra short category. There are areas of that market, AAA CLOs, for example, just ultra short treasuries, where you can get a little bit more yield today than money markets. You don't necessarily introduce a lot of interest rate duration, so similar duration risk profile. But the difference is that if rates do start to come down, your money markets have days before they start to reset lower. And that edging out onto the ultra short AAA CLO, short duration treasuries, that yield will be a little bit stickier and give you a little bit more time, a lot less reinvestment risk by even just that small tweak.
Demand for short duration bonds has remained strong in 2023. Should more investors be thinking about adding duration to their fixed income portfolios, or is it still too soon in this cycle?
Yeah, and that's the thing so I obviously mentioned edging out short on the curve is a way to get out of money markets today. The short end of the curve is still attractive. It is not, it makes a ton of sense to continue to own there when the yield curve is still inverted. There is still uncertainty about where interest rates are going to head, what the Fed is going to do, and where inflation is heading. But the fact of the matter is it is time to start thinking about duration, because yields out longer on the curve are materially higher than they have been for such a long time. And when you have that opportunity to lock in higher yields for longer, that is extremely attractive. So the starting yield generally correlates very highly to your forward 5-year return. So the opportunity today where 10-year is hovering near 5%, we haven't seen yields close to that level in such a long time. While it might feel uncomfortable, it's absolutely a great ballast within a portfolio that we need to start getting our clients thinking about today.
How have duration assets historically performed when policy rates reach their peak, and how might this historical context guide investment strategies in the current economic landscape?
Yeah, and that's a great question. When you look at history, and unfortunately, I do get the conversation about, and the question just this time might be different, which is true. It might be different this time. But if we go off of past rate hiking cycles, 5 of the 6 rate hiking cycles, when the Fed paused, cash was the worst performer. Duration assets, even 2-year up to 10-year, outperformed cash during that time period. And one of the reasons that this makes sense is because duration in fixed income serves a purpose in a portfolio for a ballast. If there's equity market volatility or rates do come down, you get that capital appreciation from those assets. We saw this tested in March when SVB happened. There was a minor panic moment in the markets, and you did see those longer duration assets outperform, provide capital appreciation. So clients really need to remember, yes, we've had pain in duration assets up until this point, but the goal of owning those is to provide that defensive balance in a portfolio. And it just so happens that you're getting a lot more yield today than you've been able to in the past. So it's an extremely opportunistic time to start edging out onto the curve, especially if we are close to the end of the Fed rate hiking cycle.
And finally, Lara, the 60-40 portfolio remains a topic of a lot of debate. As the head of portfolio construction at Janus Henderson Investors, what are you telling clients about their allocations heading into the new year?
Yep. It is hard to believe we're almost at the new year. Quite frankly, I can't believe next week is November, but it is no doubt the 60-40, the calls for the death of the 60-40 have been going on for a very long time. And what we've been saying is, if you think about the last couple of years, what was one of the biggest pain points of the 60-40? It was the 40. And why? It was because you didn't get any yield out of the 40. So you were owning duration assets of 6 or 7 years and getting paid under 2% in yield. So that 40 was not necessarily giving investors a ton of confidence within that whole 60-40 balance. Heading into the new year, that 40, the dynamic of the 40 has changed dramatically because you're actually getting paid. Fixed income, you're getting the income again. So we're telling clients actually to kind of enjoy having that 60-40 portfolio where your fixed income is once again providing you actually some decent returns in certain areas and sectors of the fixed income market as well. When you look relative to equities, there's extremely attractive opportunities risk adjusted wise to maybe even overweight that 40 where you may have not wanted to in the past. So we've been telling clients everyone is different. It all depends, of course, on what sectors you're owning, how your equity like positioning is, but we feel very confident that you can get a really nice diversified portfolio going forward in just traditional public 60-40 assets.
All right, Lara, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.
All right.